Good morning, good morning, good morning. Welcome to the webinar, the first webinar for 2024, where we will be looking at how we can actually build business value as entrepreneurs. I am grateful to have you this morning, and my apologies for those who waited to join on the webinar yesterday. I had a situation that was out of my control and I had to comply. And luckily, it was a very great and inspiring event where MMCP has signed one of their biggest funding deals with one of the development funders. And unfortunately, I could not be present to do a live webinar. Hence, I came in this morning to do a recording of the webinar, and I appreciate your continued support. And I'm hoping that there's going to be great learnings that you will be getting from here onwards and for the duration of the availability of the free webinars. In short, as MMCP, we're looking at building sustainable, scalable, and sellable businesses. Before my meeting yesterday, I was in a board meeting with one of my clients where we provide accounting services for. And the most important thing that the chairperson of the board requested was, how has the business been performing financially? And the business owners immediately said, we'll give over to our accountant to assist us with that. However, what really excited me is their understanding of each and every number in the management account. Yes, I was representing them as the outsourced CFO for the business. However, they took charge in terms of talking about their financial performance. They understood each and every line. They understood what each and every line in the management pack said about their business, and they could actually link that to their strategy. So that was quite good. And this has happened, it didn't only happen overnight, it has happened over a period of time whereby they have learned to understand the numbers, because the numbers will actually tell them whether their business is growing or not. So as MMCP, it is our intention that with the businesses that we provide advice on are sustainable and they're willing to scale. At some point, they're also willing to be sellable. So we all know that we go into business to make money. So as a shareholder in a business, you want to always increase the value of your business so that if you want to transfer your business to your heirs, you are in a position to transfer a sustainable business. If you want to sell the business whereby you want to maximize your wealth, you want to sell a business that has got value. And when we do business valuations will most actually 90% of business valuations are going to focus on the free cash flows in your business or the availability of cash flows in the business. Because any investor that comes into that wants to buy that business, they want to make sure that the money that they pay at the beginning of or when they acquire your business, they will be able to recover it by use of by when they get the dividends from the business. On the other hand, again, when you look at bankers, bankers want to provide loans to entities where they are certain that they are going to get repayments for those loans. whether the interest and being the interest and the capital repayment. So it's quite important that as a business owner, you understand the impact that your finances have on your business if you want to grow your business. I lost a client now recently, and I lost a client. One of the issues was that, yes, we had issues with how we were doing things, but what I found is that the client actually put everything on the outsourced accountant, whereby she didn't want to, they didn't want to take responsibility for their finances. And when you look at the Companies Act in particular, it requires each and every director of the business to be aware of what is happening in the business. When we sign our annual financial statements, we do indicate that the responsibility of financial statements is on the directors of the company, meaning that you, as much as you have outsourced the services, but you need to take ownership of your finances, of your financial reporting. When you go to the receiver of revenue, the representative of the entity is usually the director of the company. We as accountants, we will be regarded as tax practitioners. And whenever they require information, they will go to the director. So it's quite for a business to grow, you cannot relegate the understanding of the basics in financial management in a business. Yes, you might not know the intricacies of how certain things are done, but in terms of understanding what goes into your gross margin, you need to know that. Understanding what goes into your net asset value, you need to understand that as a business owner. So today I'm going to assist you. This is more of a high level introductory on what you need to be aware of in your business when we talk about financial management. If you're sitting in between your peers and they want to understand your numbers, then they're ready to even negotiate on a deal with you. You need to be aware of your finances and your numbers. So, and why do we need financial management in business? I always say that all these big businesses have got certain things that they do on a regular basis. And one of them, they are very strict with financial management because they understand that financial management, it assists them with decision making. I don't think there's anyone here who would like to be in business and they want to take a big decision on the business and they haven't actually looked at their finances. It doesn't work that way. So it improves your decision making. The next thing is, how do you optimize resource allocation? Resource allocation, meaning, do you really understand what goes into the cost of your business? And if you have to get someone specifically assigned to be responsible for certain costs in your business. The other one is in terms where there is, let's say, manufacturing. Are you in a position to provide the required resources for that? The next one is going to be on enhanced planning and forecasting. Every business needs to have a plan of some sort. And this plan means you know where you are going. You have crafted a way of how you're going to reach that destination. And you are going to keep track of what you are doing in your business so that you can achieve your goals. So that's what you need to do. So you need to understand your financial plan being either your forecast or your budget. And you need to know that like you know yourself. Then we come to operational efficiency. How do you know that your business is doing well if operationally you are not sure if you're doing the right thing? So there are, we call them ratios. There are ratios that you can actually have and look at on a monthly basis to assess whether there's operational efficiencies and how you are going to improve those operational efficiencies. Let's take one good example. You are in a manufacturing plant, you are manufacturing a drink, and then you know that on a daily basis, you need to produce, let's say, 1,000 bottles of this drink. But you realize that some days you are in a position to do 1,000, but some days you do 1,200, some days you do 800. And then you need to understand what makes those differences, because obviously there is some inefficiencies of some sort. If you know that the standard time of producing the drink is this much, and within a period of so many hours, you get 1,000 liters. If you get 600, it either means your production line is not efficient. So you need to go, and you can only know that once you assess your financial performance or you look at your financial numbers. Say your cost of production is higher than what you had anticipated it to be. You need to go and look at whether there's operational efficiencies, and then from there, you streamline your processes so that you can reduce any wasteful expenditure, and whereby it will contribute to the overall growth of your business. So that is why we need financial information to assess and to monitor operational efficiencies. This is quite popular in some industries where there is compliance and legal security. I provide advice to the financial planners. I provide services to them. And what I've noted is that they use financial reports for compliance. That's all. Other than that, they manage the business from the cash flows that they have in the business. As long as they've got compliance, financial statements for compliance, they're good to go. Yes, it's a good thing to have, but do you really understand some of the issues that are there? Let's take, for an example, in the banking industry. Banks are required to maintain a certain level of cash or of deposits. Yes, they're doing it for compliance. However, they know that if they do not have a certain level of deposits, they might run into a risk where there is withdrawals that they did not expect, and there is a risk where they'll have negative cash flows. So you need to utilize financial reports for compliance and, importantly, for legal security, whereby you reduce the risk of fines, reputational damage, and just creating a stable growth environment. Imagine if you had clients that came through to make withdrawals from your bank and they find that you don't have cash. There's a big probability that you're going to lose some of those clients. So proper financial management ensures compliance with financial regulations and legal requirements. Let's look at then what are the other things? Risk mitigation. We know in 2020, we were confronted with a pandemic where it led to lockdowns. And a lot of businesses were at the risk of closing down. And a majority of them, if I can say, especially those that didn't have good resources, they actually ended up closing. So where you have been effectively managing your business and understanding your financial performance and your financial standing, there will be a reduced risk in terms of in your business. So by constantly monitoring your financial performance, you reduce the risk and provide mitigating factors in alleviating that risk. Some of the risks you find that you don't have enough cash resources to pay your salaries, and it's because you didn't plan well. So we utilize financial reports for risk management. Let's look at the next one, which is debt management. Some people will say debt is bad, but we're saying there is good debt and there is bad debt. Good debt allows you to leverage the business and do strategic investments without falling into financial distress. So you need to understand how to leverage what you have to actually grow your businesses. So businesses can utilize debt to finance their growth initiatives, such as expansion, acquisitions, and any R&D process that they want to do. You need to look at the debt that will assist your business to grow. Next is the strengthened cash flows. This one is quite easy. How will you know that you have got good cash flows if you don't look at your financial management? So strengthened cash flows allows you to actually determine even a value for your business, because most valuations that we do will look at the free cash flow. If not the free cash flow, we use the EBITDA, and we know the EBITDA is almost an equivalent of your cash profits if in your business. So effective financial management ensures that there's healthy cash flow, which is essential for the day-to-day operations of the business and for growth initiatives. So businesses with positive cash flows usually have got a much added benefit because they can take advantage of opportunities that come before them, and they can navigate economic downturns more effectively. And we have seen this during COVID. Lastly, businesses with positive cash flows businesses with good financial management are easy to sell. When I was in private equity many years ago, I had to go and do a due diligence on a transaction, on a potential transaction. And when I got there, first of all, I didn't know the business was doing hedging and instruments and that. I really didn't know how they were actually making money. It was quite a complicated business. But what made it worse is that there weren't good cash flows in the business. So the business was not attractive to investors. I've also come across a business whereby they were doing so well. They were doing so well. However, their financial management was not up to standard. And the old man wanted to leave the business. However, it was difficult for any investor to actually come through into a business and take over the business, because when we needed contracts, there were no contracts. Contracts were verbal contracts. You know, those contracts that you do by the brass stand, whereby they're not reduced into writing. So and those things have got an impact. Whether it's lack of financial management, it becomes very difficult for investors to come through. Lucky, if you are very lucky and you still get investors that come through, they will not give you the price that you were anticipating, because they're going to discount all of these things that you don't have. So those were the 9 areas or reasons why we feel that you need financial management in your business. So what are the things that you need to get, that you need to have as a basic, and understand them for your business? First is a general ledger, whereby that is the processing of we call it the book of first entry. So it's more of a repository of all your financial transactions by the company. It's going to be individual accounts, which is going to be your suppliers, your customers, where your assets are located, your liability, your equity, your revenue, and your expenses. And it is a detailed record of all your transactions in your business. And we utilize that to generate the financial statement. So you always need to understand that your business needs to have the general ledger, which is the utmost important area for us to start compiling financial statements. So now I've seen that there is a big trend within, especially in small businesses, whereby when they request us to do financial statements, they will send you bank statements for 10, 12, 24 months, 36 months, and they say, please prepare financial statements. I can't call them professionals, because a professional accountant will understand that there should be books of first entry. There are those that will go and take that bank statement and produce miracles out of it. But how do you, unless if you have been given reasons to actually for each and every transaction, but where you find that there is an invoice, how are you going to claim or submit your tax returns or your VAT returns where you don't have a valid tax invoice? The other thing is, when you do that, when you only process your annual financial statements from a banking point of view, it means you are also looking at cash basis of accounting, and you are not using the accrual basis of accounting. So just to give a clarification, accrual basis of accounting says you go to a shop today, you buy, you don't buy, you get on credit. You get a product on credit, it comes into your business. That is a transaction in its own. The fact that you got it on credit, you are going to pay in 2 months, it's another type of a transaction. The first transaction is that there is a product that came in, which is stock, and there is a creditor. So that you need to raise that liability. So that is the reason why we need those invoices. The other thing is you invoice the client this month, but the client, because you have provided the service, so it means you need to be paid at some point. Because you created a service today, the liability for that customer to pay you arises today. So you invoice that client today. However, that client is going to pay you in a month's time. So can you see that you have actually missed 2 transactions by actually waiting for money to sit in the bank and only reporting then. That is why most of the business are finding it difficult to raise loans, because whenever you do the fundraising, the analyst will go and look at whether you have got debtors, whether you have got creditors, and that. If where your business doesn't have any debtors, doesn't have creditors, it means the money comes in, money goes out, and your net what we call your working capital is not managed effectively. Yes, you want to receive money up front, but you also want to pay a bit later so that you can stretch your cash. So hence we require the underlying records to be available whenever your accountant does your financial statements. Those records will be used to generate a general ledger. From then, we are going to have your income statement, which shows your income and expenses, the summarized income and expenses for the month, and we do that on a cumulative basis for a year. And on a monthly basis, obviously, you need to assess, and that's where you look at operational efficiency or profitability of your business when you assess your income statement. Imagine if you didn't understand whether you achieve your gross margin when you are selling your products. So you will see on your income statement as well. Then you have got a balance sheet. A balance sheet is an indication of where your business is as of today. Yes, we've got asset. It's made up of assets, which is the fixed assets, the long-term assets, which is the current assets like your bank stock and your debtors or your customers. And then we also have your equity, where we show your retained profits for over the years accumulated, your current year profits, and where you have got reserves and valuations, we show that. And at the bottom, we show your long-term debt, your short-term debt, your creditors, as well as anyone that you owe. We show that. So you've got almost like a snapshot. You actually have got a snapshot of the standing of your business at a specific date. So that is your balance sheet. Then we've got a cash flow statement, which identifies how you have actually spent your money and the money that you receive, how you have actually spent it. We start off with how did you spend your money within your operations? And we know within operations is the sales, the purchases, is the payment of salaries, is the payment of creditors, is the receipt of monies from your customers. So that is how you actually utilize the resources in your business. And then let's say there's some money that is left, you buy some equipment, and that equipment is going to generate income for you. We need to indicate that you have invested in your business so that investment can actually finance, or that investment can actually get some returns as you utilize those assets. Then the bottom part is where you have borrowed money or you have put money yourself in the business. It's how you have actually financed any shortfall from your operations, after you have paid for your operations and you have bought your assets, how did you finance that? If you find that there was a shortfall in the cash that you received from customers and that on your sales, it means you have to put money to finance some of those operations. So it's quite important to also understand what is your free cash flow at the bottom. Your free cash flow, meaning you have taken off your income, your working capital, as well as your investment, your tax. What is left? That line needs to indicate that your business is growing or not. If you've got free cash flow, your business will be very attractive to investors because it means you are in a position to pay dividends. You have got sufficient cash in your business to reinvest it further. So that is also something that you need to be aware of. I've spoken about the accounts payable, which is your suppliers, your creditors, and the accounts receivables, which is your customers or the loans that you made to your friend, to some business acquaintances, and that I can't say friends. And we also have, so the next one will be the purchases and sales records. I've spoken about that, which is the books of first entry. And payroll also plays an important part as part of your financial records. Salaries, we need to be able to record proper salaries because they are an expense for your business. Payroll, which will also include any payments that you make to the receiver of revenue. The other one is inventory records. Inventory records. So what happens in inventory management? At the beginning of the year, you buy a box of tissues. And no, probably tissues is the wrong example. You buy a box of pens that you sell. And as you sell, you don't record that you have taken one pen out of that box. And at the end of the year, the box is empty. However, your financial record still says you've got 12 pens. Can you see that you have overstated your records by having something in your accounting records that is not in the warehouse? Hence, it's important, especially those who hold stock, they're in the retail industry, you need to do regular stock takes. Because at the end of the year, we do evaluation of your stock. So you are in the manufacturing industry again, and there is this one product that you bought, however, it's not moving so well to an extent that no one is buying it, to an extent that it gets damaged and all of that. So meaning if you were to sell it today, you will not sell it at that regular selling price. Instead, you are going to sell it at a reduced price, meaning the valuation of that product is actually low. You need to write it off, or it is a defect. You need to write it off. So we need to understand, you need to understand your inventory record, your stock records, so that you don't overstate that. Because what overstating your inventory, what it means is that for any financier that looks at your business or even yourself, you'll think that, my inventory is still at about 5 million on the records, only to find that in the warehouse, you only have half of that. And the implication thereof is that you will not be able to fulfill orders because you will take orders, but you will not be able to fulfill them because you don't have sufficient stock. So it's quite critical that at any given time, you understand that your stock records on your accounting system and in the warehouse are regularly reconciled. Fixed assets records. Fixed assets, the receiver of revenue allows us to write off fixed assets over a period of time. So with fixed assets, we need to understand if you buy a tractor or a machine, that machine needs to be recorded in your financials because you will be utilizing that machine for the production of income. And the receiver allows you to depreciate that machine as you actually use it. Tax records. Everyone is scared of the receiver, so they make sure that they are compliant. And what they do is they'll say, no, we need to have my taxes in order. Like today, we are submitting provisional taxes. So we calculate your tax for the year and we make provision as to how much you are going to get as profit, your taxable profit, and that. So you need to have your tax record in place. And in terms of the South African law, the receiver requires that you keep your financial record for a minimum of 5 years. There are some industries where you are required to go for 10 years, some you are required to go for more than 10 years. What happened now recently is that one of my clients who bought a house in 1993 sold his house, and there was capital gains tax that happened there. And we were really battling to determine the base value of that asset. And he said, I threw away all the records when I was building the house, so I don't have any records. So we ended up going back and forth in trying to determine what was the value of the asset in 2001 so that we can claim the capital or we can submit the capital gains tax. And then I realized that, yes, you are required to keep your records for 5 years, but there are some records that are so critical that you might need to keep them for a much longer period. And someone would say, but I don't have storage. Now we've got cloud storage that you can actually use. So make sure that you keep your tax records, as you don't know what the receiver might do. They might call on for those records. Financial contracts and aid and agreements. I cannot stress this any further, that you need to have contracts. If you do a loan with your friend, that have that in writing, because should anything happen, you need to actually indicate that in your financial records that you obtained a loan. And when we do financials as well, we need to disclose some of those, all of those loans in the financial statement. And where there is a contingent liability as well, we need to do that. Audit reports, audits, there are companies that are required to do audits in terms of the Companies Act. And if you are required to be audited or you voluntarily get your business audited, you need to have the audit reports. And lastly, the budgets. I've spoken about the budgets and forecasting earlier on. You need to have your budgets. For management reporting, where you need to identify or you need to look at the variances from your actual expenses to what you have budgeted, you will not be able to make proper decisions, I said earlier, if you don't have your budgets or your forecast. Let's look at some of the implications of not keeping proper financial records or having financial records that are not compliant. We all know about Enron. Enron, they went into financial troubles because of how they were doing their financial records. Steinhoff is also a more recent example of an entity whereby they were mismanaging or they were not recording they were not properly reporting on the operations of the business. And there's a lot of them. Those who are much older will remember a company called Blockbuster. Blockbuster, they were doing videos. We used to go and hire videos from them, and the introduction of a cell phone came in, and they could not keep up, and all of that. If that business had sufficient cash, they would have done some research. They would have done some work to make sure that they mitigate the risk identified in their business not being able to continue because no one is actually hiring VHSs anymore. So there are a lot of failures, and some of them are big. If you look at some of the statistics that most institutions, chambers of commerce, universities, and that they talk on, they'll usually say more than half of startups that fail, they fail because of either lack of funding, but also coupled with lack of financial management. That is a fact. So those that survive, you'll find that they either manage to get funding and they have also managed to keep track of their finances. In the development space that we are in South Africa, and this I heard from someone as early as 2015, whereby a lot of small businesses that received grants, ESD grants, were not surviving despite them be given grants because they didn't have good financial management. When you look at business rescue statistics, most of the time you'll find that there was also no proper financial management. And where there is the decisions were taken without looking at the finances. So you need to be aware of the impact that the lack of finances has on your business. So some of the practices that I would recommend that you have in your business so keeping financial records is it's a legal requirement, so you cannot actually say you won't do it. It's a legal requirement, just do it. But some of the important things that you need to look at and constantly do in your business is forecasting. As to where is your business gonna go. And you do your forecasting based on the strategy that you want to go for, based on your goals. So you need to have your forecast in terms of where do I want to see myself in the coming year. And as you put in your action plan in achieving that, you know that that's where I want to go. You need to identify revenue streams, especially revenue streams that are much more profitable. And for those that are not even profitable, how can you actually improve that they are profitable? Lastly, cost management. The one thing that we usually say in business is that one thing that is certain and for sure is your costs. And revenue, sometimes it's not cast in stone. I signed a contract with a customer last year in November with the hope that by now I will be getting some jobs allocated to me. Nothing has happened in the last 3 months. So my revenue has reduced significantly because I'm not in control. Yes, we've got a contract, but the contract indicates that they will allocate me jobs to do. So I don't have control of that, of the revenue, but you have control of your costs. So managing your costs will assist you in growing your business. So I got this acronym from one of the books that I was reading. I can't actually remember the book, but I really actually need to acknowledge the writer of this. He says, whenever you do cost management, make sure that it complies with this acronym. the pure in profit and loss. P meaning it's something that is profitable and you actually want to have more of this because it's profitable. U meaning unnecessary, and this is an expense that you can eliminate. R meaning it's replaceable. You can replace this with a much cheaper option. And E is for item that should be left untouched because it doesn't have an effect. So when you do your cost management, as you look through each and every line in your income statement, have the pure in mind as to whether is this profitable, is this unnecessary, is it replaceable, or can I just keep it as is? So those are the 4 things that you can look at. I hope this will help you. So as a business coach, and in the work that I do, and the program that I'm running on growing the value of the business, there are 8 drivers of a business. And these 8 drivers, the first one is financial management. And this has been proven in more than 90,000 businesses throughout the world, that financial management is quite critical for driving value of your business. Identifying your growth potential, having being dependent on one customer or one supplier or one key individual in your business can either harm or can harm your business. So you need to identify if you are within what we call a Switzerland structure kind of a business, where you are the rainmaker in your business. The valuation, and this refers to the cash flow in your business, and it's closely related to your financial performance, the recurring revenue as well. Look for businesses, or look to create recurring revenue in your businesses. Those that attended my webinars last year in 2023, I have actually given them a book on an automatic customer web and 7 types of revenue. So there's a way actually how you can make sure that you're getting recurring revenue. And an environment where you are working in, are you in a niche environment or are you servicing everyone? Because we know that once you are in a niche environment, you create some kind of a monopoly control. So that also can drive the value, will drive the value of your business. Customer satisfaction. Yes, it is important because customers refer each other. The customers can make or break your business. There are some customers that will be detractors, and there are customers that will be promoters. And it doesn't help for you to have a customer that is a detractor, customers that are always taking out of your business, because those kind of customers will not help you. So here we assist businesses in calculating your net promoter score, and your net promoter score will assist you to determine whether do your current customers actually promote your business, or do they actually take out from your business. And lastly, the hub and spoke. Are you the center of your business? Are you the bottleneck of your business? Are you in a position to go on leave or to be away out of your business for a period of 3 months and your business is not affected? That meaning that you have got proper systems in your business to be able to work even in your absence. So the program that I'm running runs over a period of 10 months, and we look at specific things in the business. So the first one, I see my screen is not working, so I'm not sure what is happening. But in the program that we're running, we try to look at each and every one of those items over a period of 12 months. So if you are keen in being part of the program, you are most welcome to email us or to go to our website, make an appointment with me, and I can explain further on the program and the cost of your business. So I'm hoping that this webinar will assist you to move your business from a red to a light green and eventually to a green. So let's go out and implement some of the recommendations that are set out in the webinars. And I'm hoping to hear from you in terms of your experience in your business and what you would like to improve in your business, and where financial performance is one of them. We are most welcome to help you with it. So from me, thank you so much for joining me this morning and listening to this recording or to this and for those that did not get the recording, it is available on YouTube, and you can actually go and listen to it at any given time. And do not forget to not subscribe to our YouTube page, because on a regular basis, we usually post some of the webinars that we have, and it will make our life much easier to also understand whether the content that we are distributing or disseminating is actually helpful for businesses. And the YouTube channel will be made available as well as part of this video. So you are most welcome to actually go and subscribe. And this is Ntabi Singh Maidi. I call myself now a value builder coach, because I assist businesses to build value, to make your businesses sustainable, to make your businesses scalable, and eventually get a proper check whenever you sell your business. So I hope you enjoyed everything for this session, and have a good day and all of the best in your business. Thank you.